an order block is just an outline. It's just an outline that that covers consolidation phase. Consolidation phase is when the market is congested in one place, when the market is making a lot of noise in one place. So this is an order block. This is how it looks. So the upper part of an order block is what we call a resistance level. The lower part is what we call a support level. So don't stress yourself. This strategy is very simple because it saves you time from overthinking and then analyzing without any direction. So this is simple. This is straightforward. So what is inside here is consolidation. Consolidation simply means there is an indecision of price. An indecision of price means that excuse my spelling. Indecision of price simply means that the number of buyers at that particular price is slightly equal to the number of sellers. So if the number of buyers exceed the number of sellers, it breaks on the upper side. So this is when buyers are greater than sellers, when it breaks on the upper side. And then if the number of sellers exceed the number of buyers, it will break on the lower side. So sellers are greater than buyers, it breaks on the lower side. So what we have to do now, we don't trade inside the order block. We wait for proper breakouts. A proper breakout is when you wait for a full candlestick to close outside the order block. Rather blow that account, but you know what you did, like you did the right thing. Rather blow that account because that was a false breakout. The market, when you jumped in, came back inside and then broke on the opposite side. But just know that you did the right thing. Just that we can't avoid false breakout because obviously market makers know where sellers jump in, and they also know where buyers jump in. So for entries, like I said, I usually use M5. Why do I prefer M5 than M15, H1, H4 and all that? It's because M5 gives me more opportunities of re-entries. And if you don't have patience, that's why you can use M5, because you just wait for a few minutes and then wait for breakouts and then enter based on where the market broke, right? So imagine identifying an order block on H1. How many candlestick to close outside the order block? So M5 saves you time. This saves you time. And one thing that you must always do is that after a full body candlestick closes outside the block, extend your order block to the right. Always extend your order block to the right. Why am I saying this? I'm saying this because we don't know what is going to happen in the future. Unless you don't want to extend. If you don't want to extend, you can just place a level there. So you know that level 12,000 was my resistance, and then level 11,000 was my support. So you know that, let's say next week or 2 hours later, when the market comes back here, there's a possibility that it retraces and then goes up. But one thing you must know, that it doesn't exactly retrace at the resistance level or price or at the support level price. It might retrace in a form of coming inside the order block but not breaking the opposite side and then exiting again. So one thing you must also know is that the size of the candlestick that breaks the order block also matters. So it means that if you have checked, in most cases, if the candlestick that broke outside the order block is longer, it simply say it broke resistance. It means that the buying momentum was stronger, so it's hard for the market to come back and test immediately. The only thing you will see is another consolidation phase, and then you repeat the same thing. Another consolidation phase, you repeat the same thing. So these things work like this. These things work like this. You find that the market shoot up and then consolidate, shoot up, consolidate, shoot up, consolidate, shoot up. And this is mostly seen on lower time frame. This is mostly seen on lower time frame. If you want to check or if you want to practice this strategy, I can say gold is the best commodity to use. Always check gold and always check NAS 100. Those are better example, because if Nasdaq is going to its highest high, or if Nasdaq is declining, this is what it also do. It goes down aggressively, and then pause, goes down aggressively, pause, goes down aggressively. So within this pause, this is where you locate your order blocks and wait for re-entry. So this strategy is simple. The only thing you need to learn is to have patience. You have to have patience, and then so that you have proper entries. So like I said, on order blocks, don't exactly enter at the resistance line, or don't exactly enter on the support line. Always enter after a full body candlestick close, and then enter your trade, execute your trade on the next one. But this is also critical, but I always tell people that enter on the second one. Sometimes in the second one, if this is a buy, the second one might open as a sell signal. And then let's say, for example, you're using M5 name, so 5, 10, 15, 20, 25, and etc. And then let's say now it's 10:35 name. 10:35, a candlestick close outside the order block. So what I normally do, before 10:40, this is where I'll be counting. Do I enter? Do I not enter? So in my opinion, I can tell you to maybe wait at least, the time says 10:33, like the 3 minutes before it closes. The 5 minutes candlestick will tell you where the candlestick is gonna close. Sometimes it might start as a bullish, and then it's bearish, bullish, bearish, but within that 3 minutes, you already know how the candlestick is gonna close, and then execute. If you want, you can just also create pending orders, but I don't really prefer pending orders. I prefer just making live executions. And in terms of locating stop losses, if you're using order block, I cannot tell you how many pips do you have to place your stop order after a breakout. So what happens is that we trade different accounts, we trade different pairs, we trade different indexes. So what normally happens is that if it broke on the upper side, so this is your entry. It means that your entry is at resistance. Obviously, your stop loss should be below the support, right? So don't exactly put your stop loss. Don't exactly put your stop loss at the outline here, because what normally happens is that false breakout can come. I mean, like, manipulations can come, because market makers know. So what happens is that you can execute your trades above, yes, and then market come back and test. And then what will happen, I've seen this with gold many times, and then it comes and leave a week, a tail here, hit your stop loss. That's what we call a stop hunt, and then it goes your direction, but it has already kicked you out. So based on how much I put into the market, or I mean into my account, I don't put my stop loss exactly on the opposite. I count few pips. And then locate my stop loss. I count few pips. It depends on how you enter and how many position, how much you have risked, like to count your pips.